is Abhimanyu Nugroho with NPM 22412011. Here I will be explaining about the role of financial markets and institutions. The role of financial markets and institutions play a crucial role in the global economy. They facilitate the flow of capital, connect borrowers and lenders, and help businesses raise funds and manage risk. Overview of financial instruments and asset classes. Bonds are debt securities and represents a loan from an investor to a borrower, typically a government and corporations. Second is stocks. Stocks represent ownership in a company and provide investors with the potential to share in the company's profits. Third, commodities. Commodities are raw materials such as gold, oil, and wheat, traded on exchanges and used in the production of goods and services. Fourth is derivative. Derivatives are financial instruments whose value is derived from an underlying asset, such as stocks and commodity. There are three characteristics and functions of the money market. First is short-term debt. The money market deals with short-term debt instruments with maturities of less than a year, providing businesses and governments with a readily available source of liquidity. Second is low risk. The money market is considered a low-risk investment environment due to the short maturity of the instruments and the high credit worthiness of the borrowers. Liquidity. The money market is highly liquid, meaning that investors can easily buy and sell instruments with minimal price fluctuations. Capital markets, stocks, bonds, and investment vehicles. First, stocks. Stocks represent ownership in a company and provide investors with the potential to share in the company's profits. Second is bonds. Bonds are debt securities that present a loan from an investor to a borrower, typically a government or corporations. Mutual funds. Mutual funds pool money from multiple investors to invest in a diverse portfolio of securities. Last is exchange trade funds or ETFs are similar to mutual funds but trade on exchanges like stocks, providing investors with greater flexibility and transparency. The role of financial intermediaries and institutions. From banks, they accept deposits, provide loans, facilitate payments, and manage risk. From insurance companies, they provide protection against financial loss due to unforeseen events such as accident or death. For investment firms, they provide investment advice, manage portfolios, and facilitate trading of securities. There are three regulations and oversight of financial markets. First is transparency. Regulations aim to ensure transparency and accountability in financial markets. protecting investors from fraud and manipulations. Second is fairness. Regulation promote fair and equitable access to financial services, ensuring that all investors have an equal opportunity to participate in markets. Last is stability. Regulatory measures are designed to maintain the stability of financial markets, preventing system risk and protecting the economy from financial shocks.